how Credit One and Merrick decide your credit limit when applying. I'm here with Patrick Brenner from the Southwest Public Policy Institute, a think tank out of New Mexico. You put together policies and papers that are cited all over the internet. Clearly, you know something.
Well, you're not going to like my answer on this one,
Well, tell
Philip.
me. Tell me.
How does Merrick how does any financial institution set an initial credit limit? And I want to advise your listeners of the core reality, and that reality is that an initial limit is a risk control tool. It's not a judgment of you.
Right, right.
It is not a judgment of the borrower. It is merely just a risk control tool that is being implemented by Credit One or Merrick Bank or whatever other financial institution is extending this line of credit to you. So
Right.
subprime card issuers, they assign an initial limit primarily to control loss exposure.
hmm
It's not to evaluate your worthiness as a borrower.
hmm Got it.
Why is it $200? Why is it $300? Why is the initial limit $500? And it reflects a very simple fact. These lenders do not have any observed behavior yet of
hmm
how you're handling their specific credit product. So they must price their credit products for uncertainty. And that initial credit limit is part of that initial price or cost for the product. They have to assume that when five different credit lines of $200 each are being extended to five new borrowers, that one of those borrowers is going to utilize the entire credit line and then not repay their loan.
hmm
And establishing what is their appetite for risk helps to establish what initial terms are being offered. And these are pretty arbitrary. It's like
Okay.
the
So you're
99-cent price of a product. They're a 99-cent store. Who invented that? And why does everybody adhere to
right.
the retail consumer products having a 95-cent addendum to whatever price of
Love it.
product that they're offering? It's arbitrary. That's it. It's just
Yeah.
arbitrary.
Patrick, I appreciate you saying that. It's also about like it has no reflection on who these people are. The credit file is just thin. They just don't have the data, so they're like throwing it out. So let's talk to the follow-up. So someone is approved for $200 to $300, right? The
Mhm.
first thing these people are the banks got to be looking at, Credit One or Merit or fill in the blank of any type of subprime borrower with a thing apply giving a loan or a credit card to a thin credit file is, are they using it and paying it off? Using it and paying off. Like, well, I mean, that's got to be extremely valuable data for that borrower,
I
or
am
for
so
that bank.
glad that you mentioned that because it's the first 6 months of performance that matter more than anything else.
Okay,
The
let's talk
first,
about that.
yeah. Oh, well,
Great.
it's how a lender is actually being able to score you as a borrower using established borrowing behavior that they're able to observe firsthand.
Okay,
So
so first
sorry,
6 months, and and
yeah.
and how much of their credit limit should they be using in that first 6 months?
I don't know if I want to comment on that.
Okay.
I'm certainly not an expert with respect to like credit utilization,
hmm
but the generally accepted pattern is you want to show no more than 20% utilization.
Okay. So
And that's
so
like mainstream borrower behavior. I know it's difficult to establish only 20% utilization
yeah,
of a $200 credit limit.
yeah, $40 a month.
Yeah, you can only spend
Right,
$40 a month and you
right,
have to pay it off every month.
right.
But do that for the first 6 months and you've
Yeah.
established a responsible borrowing pattern with that lending institution, and they're more likely to increase your credit line moving forward.
So let's unpack that for the borrower watching this. And now I'm throwing these things out based on my experience of reviewing these credit reports for over a decade. But I would imagine, if let's just say a borrower has a $400 credit line or $200 credit line, you don't want to spend $40 paid off, $40 paid off. Be random in its at in the charging, right?
You
Okay,
want to make it look like it's
you
legitimate
you want to be
behavior.
natural. You
Yeah.
the borrower wants to show the bank, hey, Okay, I'm buying lunch and it's $42. You pay it off in full. Don't carry the balance. The carrying the balance is the greatest scam out there on how to rebuild the credit score. I've heard that 100,000 times. Like, oh, you need to carry balance. No, you don't, right?
No, you
Pay,
have to show repayment history.
that's what matters. So you show it. Now, the next month you spend $80 or $100, pay it off. You want to show the randomness of it, and I would imagine, like once again, I'm not the insider of the bank. I'm not approving people, but I've been around people who have been approved and have improved their credit limits, and that's a key aspect. Do you agree,
Sure.
Patrick?
I agree absolutely.
Okay.
Let's go back to that first 6 month period and why that's
Please,
so critical,
please tell
though.
me.
Why the first 6 months matter more than anything else. So let's say you do get approved for a credit product, whatever credit card is made available to you. Lenders treat the first 1 to 6 months as the high information period because most defaults show early distress signals.
Mhm. Yeah,
Banks know that. Lending institutions know that.
right. Yeah.
Also, spending patterns, they
Hmm.
stabilize pretty quickly
Hmm.
and they see that. Payment habits, they
Hmm.
form, whether they're on time payments or they're not on time
Hmm.
payments. The lending institution can see those payment habits forming or not forming, and they can
Hmm.
see that within that first 6 month period.
Hmm.
Utilization reveals behavioral risk, maxing out a credit card, borrowing as much as is made
Yeah.
available to you. That's a major red flag
Red flag.
indicator that lenders interpret. And then an issuer can also whether it can also determine whether or not a consumer is gaining any sort of financial traction, and
Yeah.
that's based on the borrowing behavior that is being observed by that lender with that specific credit line.
Yeah.
So this early window determines
So
whether the
important.
account becomes eligible for limit increases, whether it gets frozen at the current limit and no increases are extended to the borrower,
Hmm.
or whether it gets reduced. Those are the three
Hmm.
potential outcomes within the
Yeah.
first 6 months. So you could be eligible for increases, you could be frozen at your current limit, or that limit can be reduced
Yeah.
based on your first 6 months of borrowing behavior.
Great information. So let's unpack this for a borrower just gets approved for a $200 loan. Like, first of all, spend 20%, 30%, 40%, pay it off in full at the end of the month. Two, set up an automatic payment. Don't
Sure.
remember on your memory to pay. Okay. No, you can't. If you're looking to rebuild the credit, I've said this many, many times. If you're rebuilding your credit, you can't be late. Hard stop. It
Right.
surprises me. People are like, well, I want to rebuild my credit score. I'm like, great. I don't even talk about paying your bills on time. Of course you got to pay your bills. Like you have to pay your bills on time if you're rebuilding your credit, right? So in order to make sure you pay your bills on time, have an automatic draft and just make a note that you're going to look at, make sure that payment's paid on the due date, right? You mentioned about utilization rate. You don't want to max this thing out, right?
Right.
These
Right.
banks are looking
It
for
shows
this.
risky behavior.
Yeah. And you don't also want to ask for a credit limit in the first 6 months. I mean, if they're looking at your data in the first 6 months and in month two, you're asking for credit limit increase, why do you need a credit limit increase if you're only spending 20 or 30%? Like,
Sure.
it doesn't make sense. So spend it for 6 months and form these good habits. I mean, it's not about misleading the bank. It's about forming these good habits. And then at that point, after 6 months, you ask for a credit limit increase. Do you have any insight on that, Patrick, on how to ask for credit limit increase, when to ask, that type of thing?
Oftentimes, credit limit increases come directly and automatically extended from the banking institution. So let's take a look at the Merrick double your line example.
Sure.
Within the first 6 months, they're establishing that payment history. They're observing your consumer credit behavior, and all of your borrowing behavior, your utilization discipline, stable spending patterns, etc. And then after that 6 month period has lapsed, they look at doubling your limit. So if you're making appropriate payments, if you're utilizing your credit appropriately, they extend a doubling of that initial credit line that was originally extended to you. Doubling versus incremental increases is a key sticking point here. And that is because doubling that credit line, that initial credit line, which was fairly small in the credit space,
Hmm.
it does create enough headroom for consumers to improve their utilization ratios. And then borrowers who qualify for doubling of their credit limit are statistically highly likely to continue performing well.
Hmm.
And again, this is from the banking institution's perspective of ensuring that the money that is being lent to these borrowers is paid back.
Got
It
it.
also meaningfully improves the borrower's FICO profile or
Hmm.
credit profile, which helps them re-enter mainstream credit. I mean, these subprime and deep subprime card offerings are so important to the deep subprime and subprime borrowing demographics because they do facilitate mainstream credit reporting, which is a way by which a borrower can graduate back into for the first time
Hmm.
into mainstream credit, and that's the
Which
goal.
which is a key goal because
It's and it's hugely empowering. I mean, there's nothing that feels better, Philip, than getting that approval letter that I got approved for a mainstream credit card from like Chase for Southwest Airlines or whatever.
Absolutely. Anytime a client is looking at a credit one or a subprime, or as you call it, a deep subprime credit card, it's a means to an end, right?
Sure.
Don't worry about the fee or the interest rate. You're going to have this card for 12 to 24 months maximum, and you can rebuild appropriately. Um,
You have to
Patrick, I want
take
to
economics 101 before you take economics 401.
there
It's a
that
requirement.
well, and fortunately, we have the credit ones and the merits who can bring you back in, right? And this is for anyone. I don't care if you have a 450 credit score or not. This is a big win. Patrick, I want to ask about paying multiple times. First 6 months of payment history, right? You mentioned it's so important. The utilization, the paying on time, the your spending habits. It's like you're under a microscope. If you do this the right way, they're going to send you a credit limit increase right out of the gate out of 6 months. I love this
Sure.
insight. I mean, you're bringing great insight to this conversation. What if a borrower wanted to pay 2 times a month? Would that help with the algorithms, in your opinion? I mean, I know you don't know, but like you've analyzed these companies, you've analyzed these facilitators. I mean, this is what you study. What are your thoughts on that?
Well, let's look how all of this data gets reported to the credit bureaus.
Okay.
What is getting reported to the credit bureaus is a statement, a monthly statement. One time per month, a statement is generated from the lending institution, and that data is reported to the credit bureaus.
Hmm.
How many
Okay.
times you make a payment is not as important as whether or not you're maintaining appropriate utilization ratios.
Got it.
So if you're spending $80 a month on a $200 credit limit, that's 40% utilization. If you
Hmm.
need to make additional payments in order to free up available credit to show better utilization ratios, I would imagine that a bank is going to pick up on that, detect it, and perceive it as appropriate borrowing behavior.
Got it. Okay. So
I
what you're,
cannot speak on that from
yeah,
inside a banking
right.
perspective, but looking at it from like an algorithmic perspective, that makes sense to
Yeah. So
me.
what you're saying is if on a $200, going back to our $200 limit, if someone's charging $40, you don't need to make two payments of $20. But if all
Correct.
of a sudden you go out and you buy a TV on Black Friday for, $200, then hey, make a payment of $100, bring it down 50. If you can't pay it all off, right? Pay the $100 and pay another $100 appropriately. Is that what you're saying?
Well, that's an interesting example. I'm not sure how to quite answer that one. Let's assume for the
Mhm.
purposes of our hypothetical that Merrick decides to offer an initial credit line of $500.
Okay.
And I go out and I buy $250 TV on Black Friday.
Okay.
I'm at 50% utilization. And we spoke earlier in this conversation about appropriate utilization rates being at about 20%. How do I get that balance down to an appropriate utilization rate before the monthly statement period kicks in?
Mhm.
You
Okay.
have to make a payment of $150 on that $250 TV to get your statement down to $100 and then make that payment
Oh,
before it becomes due so that you're not carrying a balance.
so Patrick, this is
Yeah.
interesting. This is really interesting. It's not, I've talked utilization rate. Like I've talked a lot about utilization rate. And the number in our program is 35% on rebuilding. You're using 20, but I'll give it to
That's
you.
just
Like it doesn't,
it
I'm just,
doesn't matter.
no, I mean, I'm with you, but I've never thought about it the way you just framed it. You just shifted my reality. Like I took off my glasses. It's like, whoa, that's interesting. So what
You got to
you're
shift that Overton window, that window of discourse. That's my
move,
job, Philip.
you're doing it. So let me get this
Yay.
straight. You get it straight.
Okay.
When the payment, the statement comes,
Yes.
when the statement comes at the month, that's
Mhm.
where your utilization matters, right?
Yes.
Wow.
Correct.
I've
Because
never
at
thought.
the state when the monthly statement gets generated, that is what is getting reported to the credit bureaus.
Yeah.
Now, when you say carrying a balance, let's say I make a purchase on
Mhm.
December 1st,
Right.
right? And my statement gets generated on the last day of the month.
Hmm.
That purchase that I made on December 1st isn't going to show up until the December statements are generated at the end of December.
Right. Right. Right.
Okay. If you make a payment on that statement in January,
Hmm.
you're not carrying a balance.
Right. Right. Right.
You're making that payment on time
Without a question.
before
You're
the
you're not paying, and you're not paying any interest. There's none of that. Right.
right. Right. And that's where I think the disconnect comes into play with the thought process of you
I
need to
love it.
carry a balance and
I
whatever.
absolutely love that distinction. And I've never really thought about that in terms of multiple payments. I mean, Patrick, I've been talking credit scoring for 2000. I mean, like a long time, like 20 years, right? And I've
Mhm.
never really thought about it like that.
It's a timing
That
issue.
is great insight, and that's something I'm going to take to my to my students. What else is on your
Perfect.
mind when it comes to credit limits, how they decide? I mean, you've talked about one, it's completely arbitrary. Like, don't even make it mean anything. Your friend gives you says, "Oh, I got approved for 1,000, you get 200. Who cares?" The next is the next
It's
six
totally
months.
arbitrary. It is
Yeah,
totally arbitrary. Don't be offended by it.
yeah.
Be proud that you were able to achieve
We're starting the
approval.
process. Yeah,
Exactly. Be proud that a bank was willing to extend you credit. You did that. That's an accomplishment. Now, what are
and
you going to do with that accomplishment? You're going to
yeah.
make a responsible payment history and you're going to convince that bank with your responsible utilization of this credit limit to convince them to extend additional credit to you.
For the first
That's
six,
your
and the
that's your
first
next.
6 months are so critical, right?
Yeah. So think about this as the big picture. Credit limits are dynamic. They are not static. They're not set in stone. Your limit is shaped by what you do after approval. Do not think that you are stuck with a $200 limit credit card at first and forever. It will change. It will most definitely change.
Hmm.
It will change based on that banking institution's assessment of your financial situation, whether or not your financial situation is stable. It will assess your real time borrowing behavior, which is updated with the bank's risk model and appetite for risk. It incorporates the signals that are flowing in from enriched scoring and alternative data, and it's assessing whether or not your account demonstrates sustainable upward momentum. And those things change almost every day.
Hmm.
So if you get that $200 limit, if you get that $500 limit, keep in mind that that first 6 months is the most crucial because that is allowing a bank to determine whether or not, based on direct observation, whether or not you're a responsible borrower. And you want to prove to that bank that you're a responsible borrower. Stick it to them. Prove to them, prove to that bank that you're a responsible borrower. They will reciprocate that by being a responsible lender and extending additional credit to you.
Patrick Brenner.
Your initial limit does not define you. It is just a starting point.
There you go. Thank you, Patrick. Patrick
Thank
Brenner,
you, Philip.
the Southwest Public Policy Institute, the president and CEO. Patrick, this has been a very valuable call.